So Nicholas Bornois of Capital Inc. I would like to welcome you to this panel that is another panel that is dealing with capital raising. We just had a very successful and interesting panel on the London Stock Exchange as being a source of capital for global shipping. And now we're going to be discussing about the new landscape of capital providers for shipping. So I would like to thank everybody for joining us. I would like to turn it over to Robert Wilkins from Reed Smith. I'd like to thank each and every one of you for your support, your participation year after year, and I really thank you. And I will turn it over to Robert so he can introduce you. I don't want to steal the thunder from his hand. So thank you to everybody.
Thank you, Nicholas. And thank you everyone for joining. My name is Rob Wilkins. I'm a partner at Reed Smith, and I chair the transportation industry group at Reed Smith. Shipping has been is a hugely capital intensive industry, as we know. In the last 10 years or so has been a period of unprecedented change for how capital has come into the industry. And my firm has been at the forefront of this change across our platforms in Europe, the US, and Asia. Capital structures of owners have become much more varied, multi-layered, and financing is much more structured and complex. So we have a fantastic panel here today with a good cross-section of different parts of the capital structure. And hopefully we'll have a lively debate on the current financing structure and landscape and future trends. So first, I'd like to give each of our panelists the opportunity to introduce themselves and say a few words about their company and their financial products that they offer. Joep, should we start with you, if that's okay?
Yeah, sure. Hi, everyone. Joep Gorgels, Global Head of Transportation and Logistics in ABN AMRO. A large part of what we do is shipping finance, obviously. About 200 customers in Europe, in short sea, deep sea, and inland barging. We provide a lot of solutions for the whole capital offering, but in particular senior debt financing structures, but also M&A, DCM, and the likes, other banking products. So yeah, let me stop there.
Thanks. Elias, do you want to go next?
Sure. Thank you, Rob. Elias Sakellis from Australis Maritime. We are an investment and asset management business focusing on providing direct lending to the shipping and offshore industry. We do this via traditional mortgage loans or through finance leases. And we really lend to all segments of merchant shipping and offshore support. We are based here in London, but we have on the ground also presence in Norway, in Germany, in Greece, and in the UAE. Thank you.
Vassilios, over to you.
Thank you. Vassilios Maroulis. I head our business for Europe, Middle East, and Africa for shipping, logistics, and offshore. Out of Citi, a global institution out of the US, and we provide services and solutions for across the spectrum. So whether it is corporate finance, whether it is investment banking, whether it is day-to-day support in terms of transaction services, and then just the full banking spectrum with regards to our clientele.
Guillaume?
Hi, Guillaume Bayol. I'm a managing director and co-portfolio manager on Fleetscape. Fleetscape is a alternative credit provider. We provide direct lending to the maritime space. We cover the whole spectrum from short sea, deep sea, but also other segments such as offshore, wind, leisure. And we do that in the form of loans and also leases. we provide a pretty wide palette, and we focus on the SME, which we feel are currently underserved.
Perfect. And last but not least, Peter.
Thank you, Robert. Hi, everyone. My name is Peter Vassilios, and I'm a member of Fearnley's investment banking division. We're a full-service boutique investment bank with a core focus on the maritime industry, head office in Oslo and presence in New York. Out of all the capital we have raised so far, 2/3 relates to shipping, so it remains a core industry for us. I'm part of the team called Debt Advisory. We take a holistic approach to debt products in our advisory services, which includes everything not considered common equity, including secured and unsecured bonds, lease financings with a particular focus in Asia, as well as all types of direct lending and hybrid instruments.
Perfect, thank you. So I think the listeners will agree we have a good cross spread of involvement in the capital raising within the industry. So hopefully none of my questions can go unanswered. We're going to start with on the alternative credit side. The last 18 months has actually been a pretty reasonable time for most of the segments of the shipping industry, with the possible sectors of cruise and tankers. The dry bulk market hit an all-time high in August. So my first question to the alternative credit providers is whether an improving market has negatively impacted on the role of alternative capital providers. Obviously, you came into the industry as a result of dislocation. Do you see the improved market resulting in more or less opportunities? And how has this generally affected the provision of alternative credit? Elias, do you want to kick that off?
Sure, thank you. There is no doubt that obviously our appetite to invest in certain segments will be affected by where they are in the cycle. However, if you take a step back and you look at the overall penetration of alternative financing or direct lending into shipping, it's still very, very small, especially if you compare it to other real asset classes like real estate, infrastructure, other things. And therefore, overall, what one would expect is that the exposure of direct lenders in shipping is likely to increase over the next year. Now, what will happen, of course, it will rotate and it will look for relative value in segments which are not as fully priced as some other segments like container ships and maybe dry bulk. But overall, we would expect this to be growing exposure for the direct lenders.
Yeah, I concur with Elias. I think what is important is there's a fundamental trend behind it as well, which is the fact that the European banks have been exiting the market, well, not exiting the market, but reducing their exposure. Based on Petrofin data, it's 150 billion that has been reduced in the last 11 years. And I think that means that there's a place for alternative credit. And a rising market, as Elias say, it's a cyclical industry, so we need to choose the segments carefully. But the rising market also means that there's opportunities. It depends on the counterparties. As far as Fleetscape is concerned, this year has been the year where we've deployed the most amount of capital. We've managed to develop an all-weather strategy. And if you stick to the fundamentals to be able to have the right attachment points and focus on the right counterparties and which have the right employment for the vessels, you are able to lend even in segments that are seeing a rising market. The other thing is the Maritime offers a number of segments that are decoupled. So when dry and containers are seeing a very good cycle, you have other segments like tankers or cruise who are seeing a low point and which offer some entry points that are interesting.
Okay, and we've moved from an industry where the vast amount of capital came through bank debt finance, and as you both mentioned, the exit of a number of traditional finance banks over recent years. With the increasing market, do you expect to see your institution increasing the money out the door in 2022? Will we see other banks flooding back into the market as a result of the return to the boom times?
I hope not, but in terms of going to the boom times, I don't think that will be a healthy situation. No, but yes, I think there is a lot of capital that has gone out of the traditional senior debt finance for the last decade or so, huh? And most of that money was replaced by equity, by leases from China, for instance, and other places, but also by delevering the whole industry. So, and there has been much less ordering the last 10 years, and the ECAs came up to support the financing structures. So the banking landscape has changed a lot the last 10 years, but there are still quite a number of them that have remained steady in the business. And Citi and ABN AMRO are amongst them. We do have an appetite for more shipping finance on our balance sheet, but you also see more distribution towards other channels. I think because of increasing regulation and still a cyclicality in the market, we will all be very cautious with the within commercial banks. But there is an open invitation to do more into especially more greener projects.
Do you see your competitors piling back in the market in terms of you've seen some quite high profile lending from Greek banks returning from in the current market? Do you see that trend?
Yeah, there are always some banks coming in and out. There's definitely some increasing appetite at the moment. In general, banks are looking for assets, looking for top line, but it's different from other booms that we have seen. Banks are more cautious, and regulations have increased, and also the need for greener or assets on the balance sheet. So yeah, I would say there is a healthy supply of these kind of senior debt structures from the traditional banks.
Yeah, I think if I, from our end, I'll echo what Joep is saying. I think there are some pockets of liquidity that are reappearing. Let's put it in that way, where in effect, banks that have been never exited, but were out of the market for quite some time, are redeploying capital as their balance sheets have been fixed, and therefore there is some pockets of liquidity that have reappeared. I think overall, all the traditional banks, to the extent that they have survived and now thriving in this industry, there is a steady supply, if you wish. But at the same point in time, I don't see an unbelievable increase of capital being deployed. I think it's always going to be the right client, the right project. And I think if I can speak on behalf of Citi, the way, and I think increasingly many institutions, the way that one analyzes is less asset financing, more corporate, if you wish, analysis. And therefore, on that basis, you can deploy capital through the cycles, irrespective of asset classes, and therefore, continue to deploy capital and for sure replenish the portfolio.
And because of the, let's say, more traditional banks looking for, I think, more de-risked situations with larger companies, larger platforms, that's also why there is a nice opportunity for alternative capital providers. They jump into that void which is there, increasingly so, and that's good for the industry.
And Peter, from your lofty position, sitting above the market, arranging financings, you must see a broad spectrum of different buckets of capital available to ship owners to fund acquisitions. Have you noticed any significant new sources of capital entering the market? Unfortunately, I didn't get to hear the London Stock Exchange presentation earlier, but query of the public markets reopening for ship owners.
Yeah, I would say the public markets are indeed open. And while the bond market is not a novel source of capital to the shipping industry in general, I would argue that the current strength of the bond market opens the door to public funding for a larger spectrum of ship owners. So owners who would historically not have access will, to a larger extent, be eligible for bond financing. Usual suspects in the high yield market will be able to obtain more attractive financing, and a larger demographic will be eligible for unsecured financing. Moreover, the introduction of sustainability features unlocks access of pockets of capital that would otherwise be unavailable for ship owners, which we believe will have a significant impact in making the bond market an attractive venue for financing also going forward. Among our private client universe, I think the most noticeable addition is capital providers focusing exclusively on companies and projects with the contribution to the green transition in the maritime industry, both on the equity and the debt side. I would say particularly on the debt side, there's still a limited number of projects available for these players. But seeing where the industry is headed, I think we should expect to see further emergence and significance of those. That said, competition here is quite fierce, and in many cases competing with infrastructure capital and green bonds. So the margins are in a squeeze for players trying to penetrate this market.
Thanks. And I think it was mentioned by one of the panelists that the increasing regulatory burdens on banks make it an increasingly hostile environment for banking institutions. Vassilios, do you have any thoughts on that topic?
I think, look, it is indeed a fact that regulatory scrutiny continues to increase. I wouldn't say that this is something that it's the shipping banks or the shipping portfolios that are being targeted in any way. I think it's just across the board. The fact of the matter is that that the increasing regulatory scrutiny means that more resources need to be deployed in order for, whether it is a loan that needs to be monitored, whether it is a client that is continuously reviewed, etc., etc. And therefore, I think that undoubtedly is driving many banks focusing on core clients, not really focusing on what in the past potentially could have been a client, but ultimately not with the scale that one would have wanted. And maybe 10 years ago, you would have kept on going at it. I think at this specific point in time, as far as, at least our strategy, and I am seeing it across the board, we are focusing on core clients. We are focusing on clients that meet returns and increasingly redeploying any capital that was allocated to clients which were either smaller or didn't have the what we call cross-sell, if you wish, that was available in order for returns to be met. And therefore, when that is not happening with all the additional scrutiny reviews, continuous reviews, whether it is from the regulators, whether it is, targets that either, a bank has set with regards to CO2 emissions, with regards to its loan portfolio, et cetera, et cetera. All of that drives a shift where you're focusing there. So I would say that, does it make it less attractive? No, I don't think that it creates an impact there. What it does is that you're probably going to be focusing primarily on clients that are providing the corresponding institution with the returns that it requires in order to meet the additional requirements that are there.
So picking up on a point that Joep made earlier, Elias, do you see traditional ship finance banks as a friend or foe in the industry? Do you compete with each other, or is it the case you kind of work alongside each other in different capital?
It's definitely a friend. It's not even working separately to each other. We're working together, and there are various areas that this is coming through. First of all, if you think about it, and somebody mentioned it earlier on this panel, obviously there has been significant deleveraging of the European banks, where they want, exactly as Vassilios mentioned, to focus on what they call the core clients. That leaves a very large part of the market being non-core by implication. And therefore, we have been working a lot with these banks to effectively find solutions and take some of these non-core exposures off their balance sheets, effectively refinancing balloons or buying loans off the balance sheets or whatever it is. So this is very much a mutually beneficial, if you like, relationship. The second area is that obviously we are not trying to build a bank. We're not trying to build the entire back office infrastructure of a bank. But in order to do our business, we still need bank accounts for the SPCs that we set up. We still need, account services and all these things. And so that's an additional opportunity to work with all these traditional shipping banks who know this business extremely well, and they're very good at this service. And last but not least, obviously, the other opportunity it provides is for the banks to continue to lend and get exposure to this industry in a different way by lending to us, by allowing us to lower our cost of capital and therefore to provide a better solution to the end market. And the reason why that is possible is obviously that lending against portfolios of loans or leases effectively is subject to different regulatory rules and oversight, and therefore that creates another business opportunity for the banks and for ourselves to work together. So for all of these reasons, we definitely consider the banking sector to be our friend.
We've seen, we don't have any Chinese leasing specialist on this call, but we've seen a huge amount of leasing business, relatively low margins and high LTVs. Guilherme, how do alternative credit providers compete in that environment?
Well, I think first of all, I think the market has the opportunity for alternative financing is large because of the size of the market that was left by traditional European banks, which means that there is a place for everyone. When it comes to Chinese leasing, what you realize is that they tend to focus on a market primarily on the new builds, but also specific clients, which sometimes compete with the banks. We have a pretty large market that is underserved today, which is the mid-size ship owners. And there, I think the product that we offer is a good response. As Elias was saying, we're partnering with banks, and the product that we offer is a product that is in combination with some of the banks, which in some cases be their former lenders, but cannot lend to them anymore. But they do it through us because we offer them either through the securitization or the fact that they're lending to our balance sheet or through us to these lenders, to these ship owners. They offer that create an opportunity. In addition to that, I think we are continuously evolving. I think the fact that we've been across the board in the European alternative financing, reducing our costs to the borrower is an important point. Today with the securitization, for example, we've done with Macquarie, we managed to reduce our lending significantly. And we also have other attributes. We have speed of execution, which is something clients usually complain about when they go for Chinese leasing. We are able to do transactions in 3 to 6 weeks. And sometimes with repeat customers, we can go faster than that. We also offer structuring flexibility. I think something where banks, because of regulation, would have more issues. Depending on the segments, we can deform amortization profiles. Depending on the employment, we can allow to go higher in the LTV through that deformation of the amortization if the client has a good coverage. And we try to respond to the client's needs depending on the situation. So speed of execution, flexibility, developing new products is quite important. For example, we just did a new build financing where we're offering pre-delivery financing, which is something that some of the banks are walking away from. And we're also trying to incorporate new ESG metrics in our pricing to give incentives to the ship owners. So the combination of all of those factors means that we're able to compete, and it's an evolving state.
Well, I'm definitely not going to argue with you on speed of execution. So, Peter, ship finance has traditionally been focused on a few key jurisdictions. One of the topics of this discussion is around the shifting of hubs. Have you seen this in recent years, and do you expect this to continue? If so?
Yeah, so splitting that question in two, I guess we can talk about the public markets first, where the UK, US, and Scandinavia prevail. And we have not really witnessed any significant changes over the last years. I would say, if anything, given the tightness of the US high yield market, we're now seeing more American investors actually participating in Norwegian high yield. We typically see Asian participation in bond issues of between 10 to 15% from Hong Kong and Singapore. But this has not materially changed recently, and we don't really see any signs of this changing in the near term. For the private markets as well, I would say there is limited material change in terms of where financing is coming from, seeing as how now Chinese leasing is a staple in ship finance. We're seeing Greek banks more active, and through our presence in the Japanese markets, we're seeing an increasing number of financiers traditionally focusing only on domestic markets and clients now look outside their borders. But still, in the near to medium term, I would not expect significant changes to the incumbents in ship finance.
Anyone else have any comments on that? Okay. So let's switch to decarbonisation of our industry in the context of the current climate crisis. Shipping accounts for around 2% of global emissions, and as we can read in the paper every day, the pressure on the industry continues. The IMO, the EU are certainly turning the thumb screws with more regulation. What role do financiers have in the industry to drive change? Maybe to Joep.
Yeah, I think we have a great responsibility there to make sure that the capex comes up for new investments, either on ships that are on the water already for retrofitting, and make necessary investments there on larger fleets, or in terms of new buildings. And then, yeah, in terms of new buildings, the talk of the town is obviously what to sail on, what kind of fuel, what kind of engines should we have, how should the design of ships look like for the future. It's a big debate. It's not easy, but I think it's a very necessary thing that also the shipping industry and its financiers are having. Poseidon Principles is obviously one initiative amongst a lot of shipping financiers, which measures the greenhouse gas effect of the portfolio. Obviously, after a couple of years, that will have its effect on those portfolios, and it will steer towards greener projects. I think that will be a trend. That's a trend that we will have to show also to our stakeholders, our shareholders. But yeah, we can of course also structure, as we do, sustainability linked loans or bonds, which basically covenant certain measures that companies are taking, and that is a latest trend. It's just a variation of similar debt finance, but it caters for a sort of conditions that loans and companies need to fulfill in order to get a favorable finance structures.
I agree with you, but I think ultimately one needs to look at it, and I think so far the targets that the banks have set for whether it is their portfolios or whatever that is for the time being consistent with the IMO targets, and therefore, all in all, what you're ultimately seeing is the efforts of the financiers ultimately should be in full alignment, if you wish, with that of the ship owner. I think, as you've said, there are multiple ways of looking at this, but as far as we're concerned, there is a role that the financiers are playing, increasingly are playing, and we should be there to assist this transition. And as I said, the targets that we set for ourselves are very consistent with the targets that the ship owners need to address as we transition and as this industry transitions into wherever the future lies. I think innovative structures are going to be there and increasingly are coming into play. And I think the solutions that the owners need, ultimately, if they do work and they want to go for it, they will be able to find financing.
And Elias, I'd be interested in your take on that from a alternative credit point of view. Do you see green lending as more gimmicky? You're obviously not bound by quite the same lending regulations. So what extent does green credentials feed into your analysis of potential financing transactions?
Sure. Look, first of all, everybody will agree with the statement that was made earlier that irrespective of what is your position in shipping, obviously this is a trend that is not going to go away, and therefore you need to find a way to support and participate in this trend. The nuisance here is obviously the fact that there is a bit of form over substance sometimes, and all one needs to do is just look the differences between green financing and sustainability linked financing, and you can immediately see the difference in criteria. Some of these sustainability linked loans or bonds, one can argue that the KPIs may or may not be green at all, frankly, may or may not be helpful for, overall. Having said that, it creates tremendous amount of opportunity. And we've already, as an example, obviously, we've already financed retrofits that have to do, for example, with battery packs for short sea vessels, obviously turning them into no emission vessels, basically. And we've also financed scrubbers, which is another very, very good example of arguable retrofit, or whether is it green, is it actually environmentally friendly or not. But at the end of the day, if there's a business case to be made, for sure there are structures that can work, and we can make them work, and we've done it on multiple vessels. So we as alternative financiers are probably under slightly different types of pressures versus global or universal banks like Citi and ABN. Having said that, for for all of us, I will repeat what I said. This should be viewed as an opportunity, and we just need to figure out what is the economic business case to make of how to participate in it.
Yeah, I completely concur with this. I think even if we're not bound by regulations like the banks, I think we need to be at the forefront of green lending. And I think, but what is important as well, when we look at the debate, a lot of people are focusing on new builds and what is going to be the new fuel that is going to be used. We've been part of that. We financed some new builds recently, LNG powered, but this is a continuous debate, because even with LNG, you need to continue to improve to go to a zero carbon emission. However, I think there's a big part of the debate that is a bit left behind, which is the existing fleet. I mean, it's going to take a number of years to take the fleet out of the market and replace it with lower carbon emissions. And we need to be able to provide solutions and incentives to existing ship owners to meet the IMO targets. Our analysis says that roughly 60% of the existing vessels are going to be impacted at some point in time by the new targets. And that means that ship owners, small, mid-size, large, they're all going to need to have solutions, some of which include retrofits, modifications, and we need as financiers to be there to be able to provide them with that capital so that they can meet those requirements also in the existing fleet, because ultimately it's an effort that needs to happen across the board, not only with new builds.
Okay, and just before I go on to Peter, we will have an opportunity for Q&A in a few minutes. We're kind of running out of time, but there will be opportunity for Q&A. So if anyone has any questions, please post them now, and they'll pop up in my box, and I'll go through them in a second. So Peter, looking at it from your position in the market, do you anticipate that those involved in the shipping of fossil fuels are going to find it increasingly more difficult to access capital as a result of the regulations and pressures on decarbonisation?
I believe at this stage of the transition that we will witness a tiering of the market. So in other words, an owner shipping crude on 15-year-old tankers will not fall within the same bucket as an owner shipping crude on brand new eco tonnage running on LNG, which will in turn not fall within the same bucket as shippers of LNG, which after all to many is an important part of the green transition. I think fossil fuels will be burned for decades to come. But as long as owners try to find solutions to limit the environmental impact to the best of their abilities with the technology which is available, I think that capital by and large will remain available, at least in the short to medium term. There will, of course, always be exceptions where funds will be unable to deploy capital to anything related to fossil fuels, which we have seen in the coal industry as well. But overall, I think in the near to medium term, it will be a limited impact.
Okay, so I will open it up. We've got 5 minutes left. I will open it up for any questions. None have popped up yet, so if you have any, please type them in now. I suppose I thought an interesting question might be to ask is if you were a young banker or financier starting out in the industry today, where would you position yourself in the capital structure? And why don't we go to one of our traditional ship financiers first? Any volunteers?
If I can start first, Robert, being a young, fairly young investment banker, I think obvious answer is the bond market, which is now currently extremely hot, and we anticipate a lot of action going forward. So that would be my answer. I'm talking my own book, of course.
I think there is there's also a fantastic career to make in the traditional banks still in shipping. There is an important job to be done there. We just discussed a huge program of decarbonization that will come in the next 10, 20, 30 years. So there's a huge interesting task on us. And the good thing of traditional banks is that they usually can play in all parts of the capital structure, whether it's for their own balance sheet or for others. And I think that would be a very appealing and attracting place for a young person to work.
I agree with that, Robert. I think the needs of this industry as it transitions to whatever it will transition at. But the fundamental needs of this industry, whether it is, whenever the new propulsion systems will come up and, the replacement of the whole of the global fleet in effect, plus all the logistics chains and multiple other things, are so broad, so wide that, whether it is debt capital markets, whether it is equity capital markets, whether it is traditional shipping finance or alternative financiers, I think the capital that is required to do this is extremely sizable, and therefore the opportunity is there for a young banker to join each and every one of the institutions that are represented here and excel and actually do service and provide solutions.
Well, I'm going to have to give Guillaume and Elias the opportunity to say why it should be alternative credit providers.
Look, it's obviously very, very different types of institutions, and when you look at the young person who's finishing university, obviously there's a lot to be said in finding yourself in a very large company that can provide you a tremendous amount of support in terms of training and development in the first few years of your career. And this is something that obviously smaller platforms are not able to compete with. On the other hand, what I can say for sure is that we have been amazed over the last probably 3 to 5 years with the quality of young people who have been willing to take a risk also from their perspective in terms of their career to join platforms like ours. It has more to do with personality, I think, in cultural background and the amount of risk one is willing to take at some part of their career or not. But I'm pretty sure it's something that would not have been possible 10 or 15 years ago. So this is obviously great news for us.
I agree with that. I think. The best advice I can give a young investment banker is learn the ropes, take as much diversity in what you learn. Is it, bond market? Is it ECM? Is it direct lending? I think the banks offer an amazing platform to learn, and then there's a natural progression when you move to asset management, direct lending, where you're managing a book like if it's yours, and which has a higher degree of complexity. I mean, all of this network that they create and all of this knowledge is put to work at that moment. I think it's as Elias was saying, it depends on the personality. Some people want to jump and get directly to alternative finance, but I think the path of going through the bank can be beneficial for others who want to expand their knowledge base.
Was that your hand up, Elias, or was that? Excellent. Well, I think we have no questions from the audience. So you've obviously answered all of their questions on alternative finance and traditional banking. So it just leaves me to thank everyone for joining the panel, which I think was very interesting, informative, and to hand back to Nicholas.
Well, thank you very much from my end. It's been, as expected, a very interesting panel. As I was saying, closing the other panel before, whenever it comes to capital raising and access to capital is one of the key challenges always for shipping, being such a capital-intensive industry. So thank you very much for your insight, and great to have you with us. Thank you again, all of you.
Thank you, Nicholas, for the invitation.
Thank you.
Of course.
For the invitation.
Thank you.